The third money strategy that you can use to fund the down payment and closing costs for both for your first investment property is an unsecured line of credit. What is an unsecured line of credit? An unsecured line of credit works in a similar fashion to a credit card. You get approved for a certain amount and you can use up to that full amount, and you only pay interest on the amount of money that you use. The key difference between an unsecured line of credit and a secured line of credit is that this one does not require a property. You can go to a bank and apply for an unsecured line of credit based on your personal income and based on your credit. Where with a secured line of credit, the bank or the lender needs a property to attach to that line of credit. The benefits are, again, you're only paying interest on the amount of money that you use. No property is required to qualify. But the downside is the following. Number one, the interest rate on an unsecured line of credit could be 2 to 3% higher than what you would get on a secured line of credit. That's number one. Number two, the limit is lower because the bank feels more comfortable giving you more money that is attached to a property versus money that is not attached to anything. So the limits tend to be lower. Also, because you're paying higher interest on an unsecured line of credit, that will likely impact your cash flow on an income property and will impact the profitability. So it is important for you to account for that as part of your cash flow analysis, and also to make sure that you've stress tested the numbers, that you are running the math on higher interest, because with unsecured line of credits, the interest rate also fluctuates as the Bank of Canada changes interest rates. Lastly, when you're using unsecured line of credits, the lenders tend to account for a higher payment in their calculation. What does this really mean? It means that depending on how your personal financial situation looks like, this can impact how much mortgage you qualify for. Because the lenders take a higher payment into their calculations, that could cut down the amount of mortgage you qualify for. But it is a tool that is available to you. You can utilize it in some capacity to augment a down payment or to cover closing costs or both. And I've seen also investors utilize this tool in particular for renovations. If they need renovations money, this is a great tool for renovations money.